Continuing to roll in, and it has been a rough third quarter. Where should you be positioning yourself for the fourth quarter and beyond? We want to bring in Bill McNabb. Right now, he is the chairman and CEO of Vanguard, a company with nearly $3 trillion under management, and certainly a leader in investing overall. Good to see you, Bill.
Great to be here,
Thank
Maria.
you so much for joining us. So, wow, you've seen so much. Joining Vanguard in 1986, is that right?
That is
and
correct.
really have seen so many changes in terms of investments. We know it was a tough third quarter. Can you characterize the investment landscape for us today?
Yeah, so first of all, as you're probably not going to be surprised, we don't spend too much time worried about quarterly results. You know, we try to get our investors to think long term. I think, though, what you're seeing, and it's really played out all year, is a lot more volatility in the markets, and that tends to make investors more nervous. And so our counsel is to try to ignore the volatility and really take a longer-term perspective.
Is that what you saw in the third quarter? Were you seeing clients basically say, look, I want to just get in this for the long term and not worry, or did they become risk adverse because of the volatility we saw?
So we didn't see really any changes in terms of cash flow patterns or investing patterns, and we didn't see a lot of transactions moving from one asset category to another. So people basically ignored, at least our investors ignored the news.
You've got one of the largest ETF businesses and indexing businesses, obviously. What are you seeing there? Why has that segment been so successful?
So I think there's two big factors driving the move to indexing. One is active management as an overall category has not been able to outperform index funds.
In fact, they've been underperforming.
Yeah, and it's pretty consistent from, you know, if you look at 3-year, 5-year, 10-year numbers. And the percent of active funds that do outperform is very, very small, and it's hard to pick them ahead of time. I think the second thing that's been going on is a lot of financial advisors have actually changed the way they do business. And, you know, in the old days it was, I'm going to tell you what stock to buy or what fund is going to be the best performing fund. What you see now from a lot of the advisors is much more focus on asset allocation. And then they implement the asset allocation with low-cost solutions, which leads to ETFs and index funds.
Well, low-cost solutions is important because when you look at the active management, and Anthony, I'm going to turn to you in a moment because you are a fan of active investing, I know, and you've got a fund of funds. But when you see the costs involved in that, your average investor out there is saying, why would I pay 2 and 20 huge fees in a hedge fund when, in fact, ETFs and indexing offers a much better solution because it's so much cheaper?
That's right. I mean, our view is fees are incredibly important, whether you're talking passive or active. So, as you know, we offer, you know, about $1 trillion of our $3 trillion under management is actually active, but it's very low cost. And we think that actually gives the manager a real tailwind in terms of the ability to at least have a chance at outperforming.
So, Anthony Scaramucci, weigh in here.
Well, listen, I think there's room for both things in a portfolio. And so my only thing on the hedge fund side is that the reason why there's $3 trillion in that space is that people have demonstrated ability to reduce volatility in the portfolio and help people meet their actuarial goals. But I have a different question for Bill related to the ETFs. There's some discussion, particularly last night, Lee Cooperman, Larry Summers, talking about the ETF, the price and the underlying basket are disaggregating now. And they say that it's a result of the Volcker rule. And so basically for viewers, what that means is that stock prices are fluctuating in a certain way that may not reflect the price of the actual ETF when you aggregate those stock prices. Are you worried about that? Do you think that's related to the Volcker rule?
So we saw that, you know, August 24th was the day that I think everybody remembers really clearly. That's when you saw it at its widest. And I think there were a couple of things going on there. On the equity side, what was happening is that with all the volatility that was, in a sense, imported from Asia, if you will, over that weekend and into Monday morning, the new rules that are in place around price movements for both ETFs and individual stocks kicked in. These were post-flash crash rules. And I don't think they worked quite the way everybody thought they were going to work. And so what you saw, for example, in some equity funds is the underlying, the futures weren't trading. And so the market makers couldn't hedge their position, and therefore they backed away, which of course caused the spread to occur between, bid-ask spread.
Is that something we're going to experience in the future?
Yeah, and in a very simplistic way, when you have this stock gap rule where a certain stock can't open, you want the ETF to open, but the stocks within the ETF are not open.
And that's what's causing that extreme volatility.
Right.
Exactly.
And so I think what you're going to see is adjustments. You know, the regulators are very very attuned to this, and I would say have been very constructive in talking to the big market participants about what went on and how do we adjust the rules to take that into account.
Do you think that the fact that there's no inventory left at these commercial and investment banks that used to help the liquidity is causing another problem?
Well, I think to your, the other part of your question was, around the Volcker rule. There's no question that reduced inventories are affecting the bond market in ways that we still have yet to really see.
That's something Jamie Dimon had written about, because these banks are forced to hold all this capital, and then they're not going to have the capital necessary. I'm sorry.
Exactly. No problem. But Bill, if we were to broaden this out a bit, since you are overseeing so much money, what do you see as the biggest obstacle for U.S. markets going forward? Is it the changing interest rate environment? There's a changing political environment on the front with 2016.
Or regulation.
Yeah.
So it's kind of
all of the above.
But, our biggest concern going forward, over the next 10 years is if you look at where we're at today from a valuation standpoint, equities are pretty highly valued. If you look at where growth is likely to come in, we're likely to see over the next 10 years equity returns several hundred basis points below long-term average. We're in a very low inflationary period, so some of that is explainable. But when you look at a classic 60-40 portfolio, for example,
60% stocks, 40% fixed income.
Our best guess is you might earn 5.5% or 6% on that, as opposed to 9% historically.
We need to take our expectations down.
Yeah, and that, I think, is a real important message that people need to really embrace.
Bill, great to have you on the show today.
Well, thank you, Maria.
Thank you so much for joining us. Bill McNabb is the chairman and CEO at Vanguard, $3 trillion under management. We'll be right back.